unfriendly is nonsensical. The truth is founder friendly by definition. And I think to Chamat's point, the less complicated you make this, right? You reset the valuation, you re-up the option pool, and then everybody has a choice to make. And if the people who are on the board and backing the company choose not to re-up for whatever reason, they no longer believe in the path forward for the company, that's incumbent upon the founder to go find people who will.
That's not abandonment as it's being framed in this story. It is a trade. And I think maybe if you look at public market investors, Brad, nobody gets upset by a trade. Trade's a trade. But in the private markets, there's a lot more emotion involved, a lot more relationship material, and this founder-friendly concept of like, you're abandoning me. It's like, no, the trade here, it makes no sense for this firm and for this fund and for these LPs, right?
Sometimes the founder needs to have the courage to look in the mirror and say, what I'm doing is not working. I had a plan. I missed the plan by 70%. I'm lighting capital on fire. This is a charity, not a business. It's best to say it didn't work, shut it down and move on and do something else.
Okay. So of course you're referencing Salesforce, so we'll pivot to that. I'm joking. It's not that bad. But I think this is a good time to maybe talk about the public markets and inflation and what we're seeing in macro. So
can I set up a question for Brad, actually?
Sure. Go ahead. Yes.
Yeah.
Lovely.
So on a previous podcast, I laid out my theory of how you could just use the 2-year bond rate relative to the Fed funds rate to understand where the bond market's sort of prediction market about inflation is going. And a month ago, the 2-year bond rate was at 4.1% relative to 4.5% Fed funds rate. So in other words, the bond market was betting that interest rates would go down between now and 2 years from now relative to where the Fed had it. So therefore, it believed that inflation had been conquered. Now, fast forward just 1 month later, and the 2-year bond rate's at about 4.9%. The Fed funds rate's about 4.5%. That is a massive swing, basically 80 basis point swing in the 2-year bond rate. And so the markets seem to be saying all of a sudden, not just that they expect rates to be higher longer, but also that the Fed needs to keep raising. And that is a big change. So, Brad, what is the basis for that? And what do we now believe about inflation? I think just a few weeks ago, we were thinking that this problem was licked and the market took off like a rocket. It ripped. Now, all of a sudden, it seems like investors are really worried that inflation is not over. So where does this stand right now?
Well, I think when we started the year, the 10-year was close to 3.2, where now we're closer to 4%. The 10 minus 2 is negative as it's been in the last probably 10 years. So the market is clearly saying, we saw some inflation prints that came in hotter. I think it's now consensus, which you guys have been saying on the pod, that, although the second derivative is slowing, that it's sticky, right? We're going to get stuck at this 4, 4.5, 3.5. And it's the slope of the curve downward is going to be slower. We've gone from thinking we're going to have 2.25s to now thinking we'll have 3 or 4, and so I think everybody is now bracing for more inflation. But remember, when we started the year on January 1st, the consensus wisdom was we were going to retest the S&P at 3,200. We were going to have an earnings recession and that inflation was going to continue to run hotter. The only surprise in my mind so far this year is how well the equity markets have held up in the face of a 10-year that's gone parabolic, right?
And an actual earnings recession.
Right. And you posted, in our thread, Chamath, about just quality of earnings. Even the earnings beats are pretty low quality. And so I think, we now are going to have a couple inflation prints coming up over the course of the next couple of weeks that are going to be important. My hunch is, everybody has tilted again on, what we saw in the last couple prints. My suspicion, if you look at Morgan Stanley and Goldman Sachs, the consensus view is that we're still heading in the direction of 4% faster than I think people emotionally think. So I would say there's maximum uncertainty in the world. The fear that inflation is uncapped, the way Larry Summers was articulating in November and December, is less today than it was. But what's emerged is this idea that we're going to have higher rates for longer and we're going to have higher inflation for longer. Now, the question I'd throw back at you is the market abhors uncertainty. The market's done totally fine during periods where we had 3% inflation and 5.5% rates, right? When the internet boom that was, 2000 to 2005, rates were a hell of a lot higher than the rates are today. So I don't think that higher rates and higher inflation means that we can't, invest in venture-backed companies that have huge secular growth.
The world doesn't end.
But what I do think it means is like, if there's massive uncertainty in the world, if allocators of capital don't know whether rates are going to double again, whether inflation's going to double again, then everything just shuts down. And that's really bad for the economy. I don't see that happening right now, but I do think that the prints over the course of the next 8 weeks are going to be important.
Chamath, you have any macro thoughts here? At the same time this is happening, we saw rents broke in the last month. So rents got cheaper. Yeah.
My governing principle, I think I probably said it too many times, but I'll say it again. Rates are going to be higher than we like, and they'll stay here longer than we want. So if you use that as a principle, whenever the consensus thinks we're done, it's been pretty profitable to be on the other side of consensus. And so I still kind of maintain that we're probably going to have a 5.5% Fed funds rate, which means that, I don't know, maybe Credit Suisse will offer me 7.5% soon on 3-month T-bills, but we're going to have higher rates. And I do think Brad's right, though, in the sense that as long as we know that then that's it and we can forecast it into the future without it changing too much, it'll be okay. But right now, what you're seeing is a lot of make-believe going on in the stock market. So, Nick, if you want to just throw up that image. So this is a really interesting
This is the chart of cash flow versus earnings?
Yeah. So this is something that I saw on Bloomberg, which I thought was really interesting. And if you focus on the period of 2020 to 2024, what you see is the white line, which is net income adjusted for depreciation and amortization. And the blue line is cash flows from operations. So what does that mean?
And this is for S&P 500 firms.
This is the best 500 companies in the world.
Yeah.
And the white line is what you tell Wall Street in terms of what you make on paper. The blue line is what actually appears in the bank account. So why could there be a gap between what you tell somebody you made, I made $1, versus what's in the bank, 50 cents? Well, the reason is that there's all kinds of accounting tricks that you can use, accruals, inventories, and all of these things allow you to present a healthier earnings report than is actually true. And so right now, we have the worst earnings situation, so the worst gap between what we are telling people versus what is actually in the bank account that we've had for 30 years.